This is me about 10 years ago in a meeting with a broker trying to open up my first trading account with TD Ameritrade, back when they still had fees for trading stocks in the dark days before Robinhood. He bombarded me with terms like net wealth, inflation, interest rates, a simple interest, compounding interest, risk tolerance. No idea what any of those meant. It was an extremely frustrating experience. Not only did it make me feel inadequate to be talking to the broker, but it also made me feel like at any moment he could take advantage of me. I didn't understand what he was talking about. I didn't understand any of these concepts that he was throwing at me. But I decided at that time that I would never try to feel like that ever again if I could help it when it came to my money. With the benefit of hindsight of 10 years later, I should probably have asked what he meant with each of those terms at the time, instead of just sitting there and suffering in silence. Unfortunately, like many things in life, finance is not really one of those things they teach us in school, and most family conversations around money are kind of taboo, and it makes deeper conversations into finance very difficult to have. Sometimes the biggest challenge in learning something new is knowing what questions to ask to even begin to learn and understand what that new topic is. Host Boring Joe on today's episode of Possibility of Finances as we explore 6 of terms everybody should learn when investing. As a bonus, the one concept I think everybody should become familiar with as early as possible in their investment career. To start, net worth is defined as the value of assets a person or corporation owns minus the liabilities they owe. In layman's terms, all that really means is how much you or a corporation is worth. To use an example, if you own a $10,000 home and the mortgage on it has $20,000, before you paid it off completely, your net worth would be around $80,000. That's because if you sold the house today, that's how much money you would be able to walk away, barring no other financial circumstances. Net worth has long been one of the basic yardsticks to measure how much money we have and what is our financial well-being, or shall we say financial wealth. If you're curious about what your net worth could be, follow this very simple formula to get there. All you have to do is add up all of your assets and then subtract it by all of your outstanding debts. So in this particular case, assets could be anything from stocks, bonds, real estate, market value of your car, checkings account, and savings account. Any debts might be outstanding balance of your mortgage, credit card debt, student loan debt, car loans, personal loan, and any other financial obligation that can be quote-unquote discharged. So something like alimony or child care payments is something you can't really discharge until the end of that particular payment period. So those do not constitute debt that can be discharged for this particular example. So once you've been able to add and subtract your pluses and minuses, that final value should be your net worth. This number comes out negative, don't panic. The high cost of education can throw these numbers off. Some unexpected illness can as well. However, it might be a good idea to visit a financial planner and take a closer look at your budget just to see if there's any room for improvement to get away from that negative number. Ideally, you want to always see a positive number when you are doing your net worth calculation. Next up, we have inflation. A rise in price, which translates to a decline in purchasing power over time. This term has been in the news a lot lately as inflation has spiked over the last year. It has been steadily dropping since the closing months of 2022 due to the aggressive interest rate hikes that the Federal Reserve has taken. Something to keep in mind is that the Federal Reserve will keep fighting inflation until it reaches their quote-unquote target, which is usually 2%, and that is where the Federal Reserve traditionally tries to keep inflation. On the other side of inflation are interest. This term is used to refer to the fee a borrower pays to the lender. They come in 2 different flavors, simple interest and compound interest. Simple interest basically means that over a certain period of time, a fixed percentage of the principal amount of the loan will be charged to the borrower. Meanwhile, compound interest occurs and is added to the accumulated interest of the previous pay period to include interest on the interest paid. This is why it can feel impossible to pay off a credit card using your minimum payments, as it uses a compound interest system. These compound daily, allowing your debt to balloon out of control very rapidly, if not paid off, also very rapidly. Risk tolerance is one of my favorite financial terms because it's a very neat little tool used to gauge investors and what they are willing to invest in. Risk tolerance is defined as the degree of risk that an investor is willing to endure given the natural volatility of any given investment. Knowing your risk tolerance will allow you to develop your personal risk profile. This is traditionally split into 5 different types. The first is conservative. These types of investors are extremely risk adverse. They're willing to trade growth for safety. Their financial instruments of choice are some of the most stable in the world. Things like money market accounts, treasury bills, sovereign bonds, certificates of deposit, etc. Like its conservative sibling, moderately conservative investors will emphasize capital protection over growth, but they will venture into the worlds of indexes, corporate bonds, mutual funds, and ETFs to boost a little bit their growth profile. The moderate investor is the sophisticated investor, who doesn't scoff at the idea of a fixed returned bond. And he's also willing to listen when you tell him that Boring Joe Inc. will do amazing this year and he should invest in that stock. These investors will hold a balanced and diversified portfolio of both stocks and bonds, keeping a little cash on hand for those just-in-case scenarios. They envision a 60-40 split or even a 50-50 split between stocks and bonds as the ideal portfolio. Next up is the moderately aggressive investor. This investor believes that most of his portfolio should be in stocks, but he's no fool. He knows that bonds can help him weather the storm in bad times. He also knows that putting all your eggs in one basket is a terrible idea, so they make sure to invest in foreign stocks. This individual believes that the ideal portfolio has 65% in US stocks, 15% in bonds, and 20% in foreign stocks. Finally, we reach the aggressive investor. This individual thinks that maximum returns is always the way to go. The mere mention of a bond is enough to cause them physical discomfort. In cash, that's just meant to be used to buy more stocks. Traditionally, they also believe that having all your eggs in one basket is a bad idea, so they will spend up to 25% of their portfolio on foreign stocks. The bulk of their investments will head straight into the US stock market. Time for the bonus round. The concept that I think everybody should be familiar with, but unfortunately very few people are, is the time value of money. On a very basic level, the time value of money concept means money is worth more today than tomorrow. In the context of investing, that means that money invested today is more valuable than the money invested tomorrow, because by not investing it right away, you are missing out on generated interest and unrealized gains. I hope that everybody has found this video informational and useful. If you did, please leave a like, leave a comment, and subscribe for more content like this. Come back next time where we will begin to explore the exciting world of stocks.